Hello and welcome. I'm Richard, and this is the Art of Arbitrage. Today, on the channel, we are taking a look at Hewlett Packard Enterprise and their $14 billion attempt to take over Juniper Networks, a deal which could net investors a return of 4% or a loss of 23%, and which could, given their recent history, land Hewlett Packard back in the courtroom. Let's start by looking at the background of this deal, and then go through the numbers to see why there is such a spread between the upside and downside, and then look at the risks of backing a Hewlett Packard deal. I hope you find the content useful, and if you do, I would be awfully grateful if you would drop a like and subscribe. It would really help me with the algorithm and building the channel. So, let's get to it. Juniper Networks was founded in California in 1996 and specializes in the development of networking products, including routers, switches, network management software, network security products, and software-defined networking technology. The company generates revenues in excess of $5.5 billion and net income of $300 million per annum. The company is listed on the S&P 500 index and had a market capitalization of almost $10 billion prior to the takeover announcement. Hewlett Packard was one of the tech heavyweights. It was founded in a garage in Palo Alto, California, in 1939 and specialized in the provision of hardware and software services to companies, governments, health, and education providers. In 2014, Hewlett Packard decided to split the company into two entities. HP Inc. would take the personal computer and printing business, and Hewlett Packard Enterprise, the company we're looking at today, and which is now based in Texas, became responsible for technology services, principally servers, storage, networking, containerization software, and consulting and support. Hewlett Packard Enterprise generates revenue in excess of $29 billion, with net income of $2 billion, and has a market capitalization of $22 billion, and is a member of the S&P 500 index. Hewlett Packard Enterprise made friendly takeover bid of $14 billion for Juniper Networks in January, a deal supported by the boards of directors of both companies, but one that is drawing regulatory and competitor objection. So, let's take a look at the numbers. Hewlett Packard Enterprise is proposing an all-cash transaction of $40 per share, with an additional dividend payment of an estimated 44 cents per share. This compares to a market price of $30 before the takeover was announced and $38.78 at the time of these calculations. When we plug the numbers into our spreadsheet and consider the opportunity for an investor in this deal, we see a purchase price of $38.78, a forecast closing date in February 2025, an expected downside price of $30 per share, and with anticipated dividend payments of 44 cents. This means, should an investor take a long position in Juniper today, they can expect an unleveraged return of 4.28%, which translates to an annual rate of return of 8.83%. However, given the regulatory concerns and objections from some competitors, this deal has a lower probability of closing as such, reducing the risk-adjusted return to negative 13.38%. We should be mindful that, if the deal doesn't close and the share price of Juniper falls back to $30, an investor can expect a loss of 22.64% at today's prices. If an enterprising investor were to use 50% leverage in the transaction, they could expect a return of 6.14%, or 12.65% annualized, for a risk-adjusted return of negative 29.76%. As disappointing as these numbers are, any potential investor should be aware the situation could get worse. The deal is still subject to regulatory scrutiny, although the UK competition watchdog has now approved it, and other industry players are raising concerns about consolidation in the sector, driving out competition and innovation. We should also be mindful of Hewlett Packard's history with corporate acquisitions. In 2011, Hewlett Packard successfully bid for the UK software company Autonomy, paying more than $10 billion to acquire it. That is approximately $14 billion in 2024 dollars. This deal quickly resulted in a $5 billion write-down for Hewlett Packard, and a decade of finger-pointing and lawsuits, which recently culminated in Mike Lynch, the founder of Autonomy, being found not guilty of 15 counts of fraud. It would take a very brave arbitrager to consider this deal the best place for their capital. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.